business owners, have you ever wondered how your vehicle can help you save on taxes? In today's episode, we're breaking down the auto deduction, what it means for you, and how it can help you keep more money in your pocket.
The information presented on this program is believed to be factual and up to date at the time of its recording. We do not guarantee its accuracy, and it should not be regarded as a complete analysis of the topics covered. Discussions and answers to questions do not involve the rendering of investment advice, personalized or otherwise, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Measured Wealth Private Client Group is registered with the Securities and Exchange Commission and only transacts business in states in which it is registered or exempt from registration.
Welcome to Financial Futures, a Measured Wealth podcast powered by the team at Measured Wealth in beautiful Portsmouth, New Hampshire. Each episode, we're bringing you fresh insights on retirement, investing, and everything you need to take control of your financial future. Whether you're preparing for retirement or already living it, we're here to help you make informed choices with confidence. To kick off today's conversation, here's your host, certified financial planner and chartered financial analyst, George Zaharopoulos.
Good afternoon and welcome to the Financial Futures Podcast. I'm George Zaharopoulos. Today I'm joined by returning guest, Christine Smith. Christine is an enrolled agent with a master's degree in taxation and operates a tax practice in southern New Hampshire. Today's topic is the automobile deduction for business owners. Christine, great to see you again.
Nice to be back.
Excellent. All right. So I think we have a nice, timely conversation for today as we approach year end. Let me ask you, how common is the auto deduction? And, is this something that most or all businesses should really have a line item for?
So the auto deduction, I find on every individual tax return that's self-employed, all corporate tax returns, partnership tax returns, some trust returns. So yes, it's common on anybody that owns a business, no matter what type the entity it is. So it's something that if a business owner out there hasn't been taking it, they may want to talk to their tax advisor and ask why they haven't been taking it.
Okay. So let's say a business owner wants to put a vehicle in service during the year or before year end. What makes the automobile deduction unique and important?
So the first thing they have to think about is how many miles they drive a year. So the first year that you put a vehicle on the books for a business deduction, whether it's for 10% business use, 50%, 100%, it doesn't matter. You have to choose whether you're going to do mileage, which is 70 cents a mile for 2025, plus parking and tolls, or the actual expenses, which is basically depreciation, interest if you have a loan on it, gas, repairs, insurance, registration, and also parking and tolls. So you have to choose. You cannot flip-flop, and you can't change your mind on that vehicle until you replace that vehicle with another one.
Okay. So let's say someone chooses to lease a vehicle, and they pick a method. They actually need to stay with that method throughout the full term of the lease, correct?
Correct.
And if they pick the actual, then they need to stick with it. If they pick the mileage, oh wait, I got that wrong. How's that work?
So, you're almost there. C for effort. So if you pick mileage, you have to stick with mileage for the lifetime of that vehicle. Because you could have that vehicle for 10 years, but you have to do mileage. If you're going to pick the actual, you're stuck with it. And the funny thing is a lot of people think to do the actual because they can get the depreciation and they can do the interest on the loan. But if you think about it, that's only for 5 years. Mm-hmm. So if you do it for 5 years and after that 5 years and you keep the vehicle in good shape, then you don't have a lot to deduct. Where if it's a person that drives a lot of miles, it's 70 cents a mile and it goes up every year, even if it's a half a cent, then you're looking at a huge tax deduction for future years after that car is paid off. So a lot of times with my clients on their tax returns, the auto expense is the last thing that I fill in besides equipment for depreciation. Because if it's the first year of them buying one, then we discuss and we work out together. I believe this is a conversation you have to have with your tax advisor, and you work it out together on the pros and cons of both methods. Okay,
so I picked up on something. If someone plans to keep the auto in service for a lengthy period of time, longer than the depreciation would exist, it might make sense to take the mileage approach?
Yes, because of the mileage rate that we have. In recent years with the price of gas, the mileage rate keeps creeping up every single year. So if you look at 70 cents a mile and you drive 30,000 miles, 100% for the business, that's probably going to work out to be a lot more than a vehicle that's already been fully depreciated and you just have minor maintenance on and gas.
Yeah, and it sounds like the expense would stay in there longer. And just to break down the actual method and calculation, correct me if I'm wrong, but we're taking the business miles that are used divided by the total miles times the total cost of the vehicle, correct? On an annual basis?
To figure out the mileage amount, you mean?
To figure out like the actual, no, so I didn't say that right?
No.
Okay. So how does that work then?
So if you want to figure out how much the mileage is, take an average. If it's your first year taking it, say you come to me to do your tax and you say, hey, Christine, I've used my vehicle for business, but I also use it a little bit for personal. We have to figure out, you have to keep a mileage log, okay? And you have to figure out how much how many miles you did total and how many miles you did for the business. So that will give you a percentage if you want to compare against the actual. So say it's 75% business, 25% personal. So you take whatever the mileage was that you did for business, and you multiply that times 70 cents per mile, and that gives you what your mileage deduction is.
Okay.
Then you look at all your actual and take 75% of the actual, and I probably, for the most part, unless it's a very expensive vehicle that has higher depreciation for the first couple of years, your mileage, if you drive a lot of miles, is going to work out better.
Yeah.
So that's how you look at it. Parking and tolls, it doesn't matter what method, it gets added in no matter what, is fully deductible.
Okay.
So it's I'd almost say a personal preference, but it's definitely a conversation I have to have with especially a lot of new clients because I don't know how many miles do they drive a year. So for me, for instance, when I first started my business, I was a mobile accountant. Okay, I went to my clients. So I dropped my kids off at school and I would drive all over 3 different states and I would do people's books. So in the beginning, I had well over 30,000 miles a year business. Now I work from home. Or my office is an eighth of a mile up the street from my house. I very rarely go to clients. They all come to me. So now I look at it and go, well, when I used to drive, the mileage for that vehicle was great. Now I don't drive so much. It's now hurting me on my tax return, and I don't want to go buy another vehicle. So now I don't get a lot for auto expense because I don't drive that much anymore.
Right.
And I've kept my vehicle for, I think it's 7 years old now.
Right. So your actual maintenance expense on the vehicle now
is not tax deductible because I had to stick with mileage.
Right. All right. Okay. Okay. Great. And I picked up something there about you working from a home office. So what actually qualifies as business travel? Going to see clients, but going from your home to the office doesn't qualify. So what are some examples of that?
So going from my home to my office is called commuting, and it does not qualify. However, when I go to my post office box first to go get my mail, because I have a post office box for my business, from the post office, going to the post office, and then from my post office to my office is all tax deductible.
Okay.
So a lot of my clients, they have post office boxes.
Okay.
Or if I go to Staples to get something first, that going to Staples is not commuting. That's going to pick up supplies like paper and ink. And then from Staples to my office, that's all fully tax deductible.
And people can probably also find business travel if they're having to go to an airport, drive to the airport, or go to client meetings or sales meetings or things like that. So that's all kind of part of that as well, right?
Correct.
Okay.
Correct.
All right. And you mentioned actually the record keeping part of it, keeping a log. So what are some key components of that log? You want to know like the purpose of the travel?
So basically, technology is great. So people used to have these little mileage log books, you get them at Staples or whatever, they still have them, and they look like, those calendars, pocket calendars you get. So they're that size, and you would put, the date, and then you would put your beginning mileage, for they looked at your odometer, and then where you're going. I'm going to Staples. And then you'd put your ending mileage when you got there. So it's very tedious.
Yeah.
They do have apps for your phone, and some of them are free. That makes it a lot easier to take your mileage. Another way, and I've done an audit years ago, is I had an outside sales rep. He did the same route every single week. Same day of the week, every single week for 50 weeks out of the year. So his calendar was proof to the auditor, his schedule, that was his mileage log. Mm-hmm. And they accepted it.
Right. Wow. Mm-hmm. Yeah, I read somewhere where you can actually keep also like a 3-month sample and then annualize that sample log, which is pretty interesting. Another part of the record keeping area is, I should say, like, what effect does the business entity have on claiming a auto deduction? I know for an S Corp, people get paid, kind of take a business draw, and I read something about an accountable plan where they're reimbursed. How does that come into play?
So that could be another whole podcast. So there are several different ways. So if you're a sole proprietor, whether you're an LLC or just a DBA, it's a one owner entity. And that would just be on the tax return. It goes under auto expense. There's a little calculation that you do for the mileage or actual, and it goes there. If you have a corporation and you take a paycheck from the corporation, then usually, if you're the owner of the corporation, sometimes as part of your benefit. If you work for a company and there's an accountable, because you travel and there's accountability, that is a different podcast. But there is an accountable plan where, as long as it's written out, where you could give a copy to the IRS to say the company reimburses 70 cents a mile, and then you give a report to the HR division or boss or whatever, and you give them that. Unfortunately, the Schedule A does not allow for any additional unreimbursed employee expenses. So as an employee, you're kind of out of luck on that. An S Corp in a partnership's a little bit different, because if you're the owner of one of those and you don't particularly get reimbursed by the company for it, and the company's not paying for the car, you're paying for it personally, which I see a lot with partnerships. You can still take unreimbursed partnership expenses, just like you would the old-fashioned way on the Schedule A, and that comes right off the profit on the Schedule E. So as a partner in a partnership, you could say, I do so many miles, and then you're my other partner, you do so many miles. We take our own, and then that's deducted. There's no money exchange. The partnership doesn't get the full deduction for it. They don't get any, actually. We do it personally because you did your vehicle, I did my vehicle. So there's definitely different ways, and if you're involved in any of those type of entities, I recommend talking to your tax advisor about that, especially if it's an S Corp or a partnership. You could have missing expenses that you have never been taking.
Right, and you might actually want to have like a written accountable plan.
Correct.
For that. Okay, I want to circle back to really the big piece of this, which is depreciation. How does depreciation work on a vehicle that's been put into service?
So if you decide you're going to take a vehicle, buy a new vehicle, and you're going to take depreciation, which is the actual expenses, the first decision you have to look at is it 100% business or is it only part? Because if it's only 75% business, you can only take 75% depreciation. You can't take the full amount, okay? So let's just say, to make it easier, it's 100% business. So when you're looking at depreciation, it also depends on the type of vehicle. If it's 6,000 pounds or under, which is usually your smaller sedans and smaller like Honda Fits or Priuses, those vehicles are usually under 6,000 gross vehicle weight. There is a limit on the Section 179 for auto expense that you can take. So you can either do straight line depreciation, 5 years, kind of equal amount depending on when you buy it, but we'll just say equal for making it easy. You can take a Section 179 the first year, which is, I need to take more than the $10,000 to $50,000 vehicle. It would be $10,000 the first year. for easy math, and you may need, say, $25,000. However, you're limited to, I think it's $20,200 if it weighs 6,000 pounds or less. Okay. And then anything that weighs 6,000 to under 14,000 pounds, which is a lot of your heavier SUVs and your bigger work trucks like the F-350s and such, those vehicles that weigh heavier, you can take a lot more deduction for that. Almost, of course, they cost you more, but for the Section 179, you can take, I don't believe there's a limit except for the 2.5 million that you'd be overall for Section 179. Now you've got the bonus depreciation that they just came out with and made permanent, that it was a part of the original Trump Act of 18, and it was 100% for the first year or two, then went down to 80%, 60%, 25 was actually going to be 40%. Now they have made it effective for anything purchased after January 19, 2025. They've made it 100%. It is now a permanent tax change. Bonus depreciation, you can take on any vehicle.
When would someone want to fully take on that 100% bonus depreciation? Because you take all the depreciation 1 year, you have nothing further years. So is this for a company that buys vehicles annually or something?
So it's a really good question, George. So yes, it is for when you look at taking, again, with your tax advisor, taking 100% bonus depreciation on something, most likely it's a company that is always buying equipment or vehicles. So say it's a landscaping company. They're always buying trucks because trucks are always breaking down. They're always buying mowers, trailers. So they're always buying new assets. So then it may not hurt their taxes in the next couple of years because they know they're always buying. Now, when you deal with someone like myself, who is a personal service type of company, for me to take it all in 1 year, I don't really buy equipment. I buy software. That's what I buy every year. Maybe a printer here or there. So I think you have to look at the type of industry you're in. Some people will take it because they need to make sure that they have enough money to pay their taxes. They know what their numbers are going to be the following year. I honestly do not recommend. It's always a question that I have for my clients, and I always say, if you take 100% of it, this is what your tax liability is. Sounds great, doesn't it? However, if you're not buying anything the next couple of years, you're not going to be happy with the numbers that I give you, but okay. And then I'll give them, so you can, the cool part about the Section 179 is there's pros and cons to both of those. So, and that could be another podcast that we could do in the future. So I'll just touch base for the auto. So we're going to say that it's over 6,000 pounds, so we're not limited to the 20,000, okay? So now we're looking at the Section 179. Well, the Section 179 cannot bring you below zero taxable income on your Schedule C. So you can't, basically you're stuck. So the Section 179, you can play with the number and get yourself to zero and then take the rest over the next 5 years. That's fine. Bonus depreciation can put you in a negative, and you can take advantage of that loss against other income on your tax return. However, if you're self-employed, you may not want to do that because it's not really saving you on your 15.3% self-employment tax. So there's pros and cons to both methods of depreciation and how much to take that first year. And again, it's working with your tax advisor saying, well, what if I have a $70,000 truck and I take $20,000 this year? So what happens if I do straight line? What happens if I do 20? What happens if I do 30? What happens if I take bonus depreciation? And the one thing you have to remember with the bonus depreciation is you have to elect out of it, and it's for the whole class. So if you buy 3 trucks for your construction company, if you can't say, I'm going to take bonus depreciation on one and not the other 2. It's all or nothing per class. So you either elect to do it or you elect not to do it and take the 179. So you have to keep that in mind as well.
For depreciation, though, for vehicles, if they did qualify for the 100% bonus depreciation, but it made sense to take maybe a portion of that this year and a portion of that next year, is there flexibility on how much depreciation they can take each year?
Not with the bonus. The
Okay.
bonus is 100% first year, that's it.
Okay.
The Section 179, you have some flexibility. But again, your first year of taking depreciation, after that, it's whatever the numbers work out to be to stretch it over 5 to 7 years.
Okay.
So it's really personal preference at that point with your tax advisor, as far as there could be other things on the tax return like capital gains. The spouse maybe got a huge bonus, and you may need to take the bonus depreciation to reduce the overall tax liability. But again, that's at tax time with your advisor. But keep in mind that vehicle you have to have in service by 12/31, or you can't take any of this until next year in 26 when you put it into service. So it can't be, I ordered a new truck, it's being manufactured, I'm not going to get it till January of 26. It has to be, you have to have it in your possession and in working for the company by the end of 25 in order to have it effective in 25.
All right, that's interesting. And just going back to the weight of the vehicle, I believe that's called, the term is GVWR, and that stands for gross vehicle weighting rate. And then, of course, you mentioned a lot about depreciation, and I think we could definitely do whole nother podcast on depreciation and get into more equipment as well. So a lot there. And you actually touched up on something I was going to ask you about, deducting depreciation against a spouse's W-2 wages, and that's a possibility. But there is a downside to that if you're self-employed, because then you can't.
Yes.
Okay, you can't get away from the self-employed taxes. Or the FICA taxes, something.
Yes, the FICA. It's the 15.3%, which is your Social Security, Medicare. As a self-employed individual, you have to pay both sides.
Okay, great. Christine, are there any rules of thumb that people should be, considering if it's a low maintenance vehicle, yet they use it for high mileage, then clearly the mileage method is preferred? How about for a vehicle that has maybe high maintenance costs, but you're only going to use it for very few business miles? Would that be a case for the other method?
So, for example, like landscapers that do plowing, okay, they have a lot of plow trucks that they may not use throughout the year. They're just specifically for plowing. Those need a lot of repairs depending on how their employees plow. And those would be more that would be on the books as actual expenses, because you are going to have higher repairs, because you're going to have the plow, the electrical, the hydraulics, and all those type of things. So yes, that's where it's an individual basis. And it's not to say that like a landscape company, they could have 10 vehicles on the books. 4 of them could be for regular landscaping where they would take the mileage, and the rest could be just actual because they're more local in the same area. So I think it's definitely, it's the structure of your business. You have to look at it as a whole. To me, a lot of, in the past I've run into on tax returns that I've reviewed for others, that a lot of times it's that quick fix. Like, I need to save money on my tax this year. I'm going to buy a vehicle. I'm going to depreciate it. But if they don't look at what it's going to do for the life of that vehicle, then that quick fix was only good for 1 year. Mm-hmm. And then the rest of the years, they're going to be like, well, now what do I do? Mm-hmm. And they're going to regret making that decision, and besides omitting the return, which the IRS would kind of frown upon for something like that. So you really have to think this is a long-term investment. Some people like to just lease vehicles, and every 2 years they trade it in. They keep it low mileage underneath the lease thing, and they just want to drive a new vehicle. And it's really personal preference. And there also is, when we're talking about the auto deductions, and especially you brought up the accountability plan, which is another whole podcast, but there's also something called the luxury vehicles. Mm-hmm. Anything over a certain amount, which the IRS has different every single year, they set it. I think this year it's like $60-something thousand. If the vehicle costs more than that, it is limited on the business side as far as deductibility on certain, because face it, a contractor doesn't need to drive around in a Lexus that drives itself. Mm-hmm. You know what I mean? Mm-hmm. So they're trying to keep people from buying $200,000 vehicles and taking those as business cars. So you have to, make sure that you talk about that with your tax advisor if you're looking at a higher end vehicle.
Yeah, I think the whole auto deduction really requires some tax planning.
It does. Before 12/31.
Right. And make sure that if you do decide to put in a vehicle in service prior to 12/31 and we're getting close to the end of the year, you do need to put on at least one business mile to get that into service.
You need to have it. You need to have possession of it to say that it was in service for the whole year. But for the most part, you're not going to have any mileage on it. So then, if you're planning near year end for something like this, if you're looking at buying new, you may want to say, you know what, I'm not even going to take possession of it till January because I'll just do everything in 26 and I'll gear my tax planning for 25 with utilizing other tax benefits possibly, or paying a little heavier tax, knowing I'm going to get that bigger tax deduction next year. Again, work with your tax advisor. This is the biggest question that I get in October, November, December from my clients. They start in September asking, do you think I need to buy a new vehicle? Whatever. But to me, I throw it back at them. I'm not going to it's not my company. I'm not making the decisions for them. I will help them make the decision by giving them all the pros and cons to everything that we just discussed today. That helps them make an educated decision on how they want to move forward with an auto expense. The last thing that I would mention, though, when we're talking about it is, for depreciation, if you decide to do action when you depreciate it, when you trade that vehicle in or sell that vehicle, that depreciation that you've taken as a tax deduction is recaptured. It's called recapturing depreciation. And you have to pay tax as an ordinary income, but you have to pay tax on that money because you already got the tax benefit from it. And if you use it for a trade-in, which a lot of contractors and landscapers, I'm not really picking on them, but they have a high turnover of vehicles. That's why I keep mentioning them. When they trade in for another one, then we either decide we're going to, for the new vehicle, how we're going to do. So we may either reduce the depreciation already, what we're going to take for the new vehicle, by the amount of depreciation we've already taken, or we go back and say, no, we're just going to pay ordinary income because my tax rate's lower this year. And so, again, that's something you deal with your tax advisor. But just be aware, any depreciation that you take on a vehicle, when you get rid of that vehicle, whether you scrap it, trade it in, sell it outright, is recaptured.
Okay. Wow. There's a lot to consider. And, you definitely want to talk to your tax advisor about this deduction. I mean, clearly there can be a significant impact, but you do want to be in compliance with this deduction. You can't just say, hey, I drove 30,000 miles last year. You do need to show some kind of proof if you were ever audited. And, you want to know the purpose of the trips that you're making. So it is very important to speak with your tax advisor for this deduction. And for our audience, really the purpose of today's podcast, tax planning is an important part of wealth management. When it comes to deductions for your business, there are trade-offs to consider and decisions to be made. Each business may use their assets differently. Check your prior year tax return. If you're not including your automobile usage in your tax strategy, it may be time to speak with your tax advisors to see if that's an option for you. Christine, thank you for joining me today.
Thank you for having me again.
All right. And thanks, everyone, for tuning in to Financial Futures, a Measured Wealth podcast. If you enjoyed today's episode, please be sure to follow or subscribe on your favorite podcast app so you never miss an update. Want to learn more, get in touch, head over to measuredwealth.net where you'll find prior episodes, helpful financial planning guides, and more. You can also call us at 603-431-1444 or email at info@measuredwealth.net. That's info@measuredwealth.net. Thanks again for listening, and remember, the future will someday be the present.